to the Global Strategy and Emerging Markets Conference here in Ithaca at Cornell University. My name is Lourdes Casanova, and I'm a senior lecturer and the director of the Emerging Markets Institute. And to give us a welcome, we have here with us Kevin Hallock, who is the Dean of Cornell S.C. Johnson College of Business and Joseph Rich Professor of Economics at the Human Resource Studies. Thank you very much, Kevin, for being with us at this time, 6:02 p.m. on a Saturday evening. Thank you.
Thank you, Lourdes, and thank you all for being here. I hope you are all safe and well. On behalf of the Cornell S.C. Johnson College of Business, I want to welcome you here to the 5th Annual Global Strategy and Emerging Markets Conference. I'm really pleased and grateful that colleagues at Cornell University's Emerging Markets Institute and the Cornell Institute for China Economic Research have played a key role in convening this meeting. We are also appreciative of contributions from our partners at the University of Texas at Dallas, at Northeastern University, University of Miami, and Simon Fraser University. A special thanks to Professors Ravi Ramamurthy, Mike Pang, and Daniel Shapiro for co-chairing this conference, along with my Cornell colleagues, Lourdes Casanova and Christopher Marquist. As you know, the Emerging Markets Institute just celebrated its 10th anniversary. I hope you'll join me in congratulating Lourdes, the director of the EMI, for her continued work in promoting the importance of emerging markets and her work in organizing today's conference. While Cornell's Institute for China Economic Research is younger than the Emerging Markets Institute, it's very active and important in our research mission at Cornell. Dozens of faculty members across 6 colleges at our university are involved in this institute and are actively contributing to solidifying Cornell's status as a powerhouse for research in China. The theme of the conference, Competing in the Digital World, is particularly salient as we gather virtually for this year's conference. As today's conference program says, digital technologies are profoundly influencing the global economy and creating new business opportunities for emerging markets. At the Cornell S.C. Johnson College of Business, which is comprised of 3 schools, the Dyson School of Applied Economics and Management, the School of Hotel Administration, and the Johnson Graduate School of Management, we are hard at work to harness the power of technology to create opportunities for innovation in business, to empower people to create shared, sustained prosperity. We prepare people-centered business leaders who can bring together people and technology for the betterment of business and society. My hope is through the college's continuing efforts and through the rich discussion that will occur at today's conference and beyond, that we'll find pathways for innovation and positive societal impact at the intersection of people, technology, and business. In closing, thanks so much for being part of this year's conference. I wish you the very best for success in the conference, and I hope that you and yours stay safe and well. Thank you.
Thank you very much, Kevin, for again being with us at this time. And now Chris, my colleague Chris, will continue and he'll introduce the conference. Chris, the floor is yours.
Thank you, Lourdes. Great. So can you see my screen, Lourdes? Great. Okay. Well, thank you and welcome, everyone. You know, it's really wonderful to be hosting all of you at Cornell for this 5th annual Global Strategy and Emerging Markets Conference. I'll just provide a little bit of overview of the conference and welcome before diving into our 2 keynotes. So as Kevin mentioned, this is part of a consortium actually that is chaired by 5 different individuals. Here we all are, Lourdes and myself from Cornell. And then other members of the consortium for global strategy and emerging markets are University of Texas, Dallas, represented by Mike Pang, Simon Fraser University, represented by Daniel Shapiro, and Northeastern University, represented by Ravi Ramamurthy. So this is the 5th annual conference. Also, as Kevin mentioned, competing in the digital world is the theme. This is, I think, obviously a very salient, important theme given the world today. Topics such as 5G, AI, big data, et cetera. Things that actually I don't think our research looks at enough, particularly not in emerging markets. One of the areas that is a big representation of the conference is China. And I think many of these topics are hugely important priorities of the Chinese government, Chinese economy. And so I think that we'll have a really good discussion about some very important and timely issues. You know, as you can see, here were the prior conferences in Miami, Boston, and Dallas. So we got submissions from a lot of countries. About half are from the US, although obviously researching emerging markets, about a fifth from China, a little over a fifth from China, also Europe, India, South America, and a few others, Singapore and South Africa. So it's a wonderful diversity of papers we have represented. Let me just give you a little bit of a sense about where we'll be going over the next 2 days. Lourdes, a little bit later, is going to go into each of the paper sessions in more detail. So we just had the welcome by Dean Halleck, as well as Lourdes and I saying a few words. Our two keynotes this evening, Andrew Caroli, who's the Deputy Dean and also Professor of Finance here at the S.C. Johnson College of Business, and Denise Ordano, International Finance Corporation, will also be saying a few words. We have two paper sessions, and then as well as a series of roundtable sessions, which you'll be able to go to if you so want. The second day, we're going to have a session on a little bit of the research at Cornell on emerging markets. You know, this is, I think, a real specialty of Cornell across many different schools. So we have myself and Lourdes, as well as Ying Hua, who directs the school's China Center, Shanzhen Li, who directs CICER, who is a co-host of this event, and Dean Halleck mentioned in his remarks, and also Kunyuan Chao, who is a PhD candidate in our Johnson College of Business and has done a lot of work for the conference. So we have to thank Kunyuan as well. We have an editors panel, experienced editors at a number of journals that have published in support of emerging markets research. And then we'll also have a presentation of the best paper. So in the program, you can see there's a number of papers that are nominated for the best paper, and we'll be announcing the best paper at that point. We'll have two more paper sessions, and then also another set of roundtable sessions. So with that, welcome again, and I will turn it back to Lourdes, who will introduce Dean Caroli.
Thank you, Chris. So we have today with us Andrew Caroli. Quite a few of you may have met him before. I understand that Mike Peng before had some work together. And so hi, Mike was the chair last year. He hosted us at UT Dallas, excellent conference last year. As I told Mike, difficult to compete with you. And this time we are online, but we are doing our best. So Andrew Caroli is Deputy Dean and Dean of Academic Affairs at Cornell S.C. Johnson College of Business. Also, he's Harold Bierman Distinguished Professor of Management, and he will be presenting his book with adding some data about COVID. So thank you very much, Andrew, for being with us on a Saturday evening at this time.
Thank you, Lourdes. Hello, everybody. Can you hear me? I'm looking at Mike Peng in the picture there. It's wonderful to see you again, Mike. I remember him as a young assistant professor, newly arrived at Ohio State's Fisher College of Business, where we were colleagues together, interacting in the printer room regularly. It was great. Great to see you again, Mike. Congratulations on all your success at UT Dallas. And thank you, Lourdes and Chris and Kunyuan, for inviting me. It's really, really a pleasure. It's a nice introduction. Hello, everybody. I hope you are all well. I am pleased and honored to be serving as one of your keynotes, one of your two keynotes at the 5th annual. Cornell is proud to host it. You heard from Kevin, virtual as it is, and our Cornell colleagues, Lourdes, Chris, along with Mike from UT Dallas Northeastern's Ravi Ramamurthy and SFU's Daniel Shapiro. You deserve our gratitude for assembling what is a first-class program. The theme, first and foremost, is of course on the study of emerging markets, but this tilt toward digital transformation of international business is really intriguing. Entrepreneurship, cross-cultural management, organizational structure. I did a little searching around on the program, and a couple of papers really popped off the page for me. The one by Ach, Sarb, Komloshi, Song, and Audrech on firm complexity in emerging markets and the sharing economy. Clearly, this is one of the, the sharing economy. This is the Ubers and the Lyfts of the world. They are transforming trends globally, and the emerging markets are no exception. So that one definitely popped off the page for me. The other one that caught my eye is the paper by Professors Oja Korotu and Oba Akpowo Gaha on China's investment in technology in Africa. And that one caught my eye because of all the articles I'm reading about with respect to Huawei, ZTE, China Telecom in countries like China, Nigeria, in Nigeria, Ghana, Ethiopia, what people are in the press, popular press, are calling the China's digital Silk Road. Congratulations to those authors and to all of the authors on the program for securing a coveted spot. So when Lourdes, Chris, and Kunyan and I got together and talked about what would be fun to present for the keynote tonight, they encouraged me to talk about my own work on emerging markets. Now, for those of you who don't know who I am or haven't seen anything that I've written over the years, I'm 30 plus years into the business as a scholar. And my almost single-minded focus has been on the study of financial globalization and its consequences for firms who interact with, investors who participate in, and all sorts of intermediaries like stock exchanges and banks that facilitate the interaction between firms and investors. So, and to me, honestly, for somebody that is a scholar in the study of international markets, the financial globalization, as it were, honestly, emerging markets is like the most exciting laboratory for it, because that's where a lot of the action really resides. So what I thought we would do today is bring a familiar lens, but a fresh look to the study of emerging markets, and particularly during this incredibly painful year of COVID-19. So I'm gonna share my screen and hope that it works. Okay, I don't know if Mike, can you see? Let's test out. Mike Punk, can you see it okay? So there's the title, you guys, COVID-19 and the Enigma of the Emerging Markets. I know that sounds odd. The title sounds a little odd to you. I'm hoping in about 4 or 5 slides, it's going to make some sense. And I'll certainly relay to you why I chose it. Honestly, the human cost of the pandemic in terms of infections, illnesses, and death has been unquestionably a tragedy. Some have even estimated the economic toll of the pandemic to be in the tens of trillions of dollars. And we're seeing a lot of scholars now devoting attention to COVID and as again, another unique laboratory towards understanding some of the things that we conventionally study. So that's why I call it a familiar lens, my research on emerging markets, but with a fresh look in this newer context. So now, a couple of weeks ago, the World Economic Outlook of the IMF was released. And honestly, the World Outlook projections for this year, our year of COVID, and the next were revised from April. And the numbers are honestly quite sobering all around the world for 2020. And they're now looking worse with the October revision that was put out. Let me see if I can get the numbers here for you. This is table 1.1. It's the one everybody looks at during WEO week, World Economic Outlook week. The World Economic Output growth in 2019 was, as you can see, 2.8% there. 2020 is expected to be now minus 5.5%, down 1.1% from our projection back in April. What's especially interesting to me, to my eyes here, is that this downward revision since April is even more dramatic in the emerging market space. I don't know if you can see the two bold-faced rows there. So what you can see is that the wheel has basically downgraded even more dramatically here, the emerging markets, from what their projections were of minus 3.3%. Not as bad as in the advanced economies of minus 5.8. But the revision has been even further downward for 2020. So they're now almost equilibrated. Emerging and developed are almost about the same for 2020. And then of course, we're projecting a rebound in 2021. Of course, there's a lot of standard error, standard error band is wide around these numbers. But still, there's a downward revision in what our projected rebound is for 2021 in the emerging market space. The toughest numbers to look at here, I don't know if you guys can see in the sub rows here, are in emerging market space, definitely India, looking at booking about minus 20% potentially, as large as Latin America, especially Mexico, parts of Africa, especially South Africa. China in 2020 and 2021, I'm not going to surprise any of you experts out there. It's looking like the bright spot in this whole picture in some sense. Now, honestly, I'm a finance guy, so I look at stock market indices. Year to date, the emerging markets have been nothing if not volatile. Investment flows have fallen through the floor in March. Look at, this is the picture of the MSCI Morgan Stanley Capital International Emerging Markets Index. It's the one we all look at. It dropped, as you can see here, I don't know if you can see my cursor pointing over it. It dropped almost 50 to 60% here in basically the first few weeks of March, like many markets around the world. And what you can see here is that there's been a rebound almost back to where it was before. This is as of last week, the end of October. This is a picture out of the Financial Times that paints a picture of portfolio flows into emerging markets. So that was prices, this is quantities. You can see that investment flows, honest to goodness, fell through the floor in March. Cumulatively, we're talking about $80 billion capital stop in like 4 weeks of March. Almost all of that is in the equities, stocks in the emerging market space. A chunk of that is in China, but really the focus is on equities in the emerging markets broadly. What's really interesting, and that was featured in the Financial Times story from last week, is the rebound. You can see that the magnitude of this cumulative loss sort of stops out by the end of middle to the end of April, to the point where we're now at this point, May, June, July, now booking neutral or positive inflows into the emerging markets, particularly into China. That dark blue above the line there is portfolio flows into China from around the world. Okay, so here's a fun part. On April 16th, I was fortunate to be invited to give a webinar, and it was hosted by the Darden School at University of Virginia, and there were several hundred industry and academicians at the event. And we were talking about COVID. That was my focus of my talk. But the focus at that point was the cumulative downdraft, not the rebound, but the cumulative downdraft in flows out of emerging markets. We had not yet seen the whipsaw, the return to normal, as it were. And people were asking me a lot of questions about what was going to happen. Of course, I was not willing to hazard a guess. That's just not what I do. But I did make a bold prediction. Andrew hazards a bold prediction on April 16th. You can go download the video if you want to see it. My bold prediction was that I expected that the experience that would follow would be very different across the emerging markets. I didn't know what the ultimate direction would be for all emerging markets, but I expected that if there was going to be a rebound, it would be only in some markets and not in others. and basically just emphasizing the heterogeneity across the emerging markets. Now, this is that same graph I showed you of the MSCI Emerging Markets Index, except it's components. I've got all the different emerging markets featured here. Now, okay, I'm going to admit that in April 16th, I was looking at the stock market returns of the individual national stock indices. And now, to be honest, if you had looked at this part of the picture right here, you would have said, gosh, these markets all basically crashed somewhere between 40 to 50 to 60% all together at once, a giant co-crashing of emerging markets in those first few weeks of March. These are all, by the way, US dollar denominated indices. So the currency is embedded, currency movement is embedded in here. The story is the markets themselves, however. At that point, I had not seen what would follow. And I don't know if you can see with me here, but there has been a huge dispersion in the rebound of these markets from basically the third week of March all the way through to the end of October. The big winners have been Argentina. It's about a 60% rebound, okay, from the trough here in the third week of March. And other countries like China, Korea, and Venezuela have done quite well in those 6-7 months. While Turkey, Russia, Egypt have basically dropped like a stone with everybody else in March, but have not rebounded at all. Now, that's the picture of the prices. What about the quantities? Well, ladies and gentlemen, I hadn't peeked at this in April 16th. I guess you're going to have to take my word for it. But the fact is that even that large downdraft in portfolio outflows, that giant capital stop in March, was also quite uneven across the emerging markets. In fact, you can see here that Sri Lanka, Brazil, Oman, Nigeria, Venezuela, Argentina, Pakistan were the ones that just experienced the most dramatic outflow in that period. Now, I'm a little bit cheating here because these data I extracted from Treasury International Capital. So this is really the downdraft in portfolio flows involving US investors in those emerging markets. So on average, it was a big negative. It certainly was a big negative, lots of negative numbers here for US investors as well. But look how uneven it is. And there are some countries, those red ones on the far right, that clearly show that there was no downdraft at all in March in some of these emerging markets. So if you look at the overall aggregate, it kind of deceives you. It kind of masks what's really going on below the line. Now, if you're asking me what happened since, again, from Treasury International Capital, I collected this data for this talk. This is the rebound, the return in portfolio inflows back from the trough that we saw in April through July. I only have data through July, unfortunately. That's the latest numbers out of the tick data. And you can see, again, there's very big differences. And in fact, there's some interesting negative numbers that have sustained. So while across most emerging markets, we've sort of returned to normal, Turkey and Venezuela have not rebounded in terms of portfolio flows anew. Unlike, for example, Brazil, Taiwan, Sri Lanka, China, Nigeria, South Africa. In fact, China in the previous graph didn't actually drop all that much, but people have doubled into China again, at least from the US perspective. So that is what is going on. There's interesting patterns. I would call them conflicting signals. And clearly, we as those interested in the emerging markets, I think, crave some clarity of thinking about what might be going on. And now you're wondering, why was I so confident back in April about my prediction that there were going to be some very big differences in these rebounds? And the answer is, I'm not going to surprise you. I've seen it before. I've seen it before, and so have you. Scholars have been writing about the differences in the quality of institutions in these emerging markets as the single most important things that separate them, the quality of the legal systems, the quality of the governance and reporting systems, the investment, trading, and doing business infrastructure, as it were. That's what really makes the emerging markets so interesting, is their differences in these characteristics and attributes. And it's really been interesting to study and their evolution for decades. And that's why I wrote in 2015 a book. I wrote a book, and it's called Cracking the Emerging Markets Enigma. There's a website, emergingmarketsenigma.com. I am not hawking this book to sell it so that you buy it, but you're welcome to, of course, if you want. It's available at all the usual online booksellers. There's for many in China. Wisdom Tree Press has published a Mandarin translation of this. I think I've done a book tour in China a couple of years ago with the book. What I'd like to do now is talk a little bit about why I wrote this book, what's in it, and then at the end of the talk, before I get the poll from Chris or Lourdes, I'm going to actually dare to show you these indicators that are featured in this book that I've been measuring over the last 2 decades, actually show themselves to have some interesting predictive power, though of course they were never designed for it, to help us understand what happened during the COVID period in the last year with respect to the heterogeneity across these emerging markets. So there it is, Cracking the Emerging Markets Enigma. Go to the website and you can get a quick take on it. So what is this book about? So in this book, honestly, it's a culmination of a lot of mine, and not just mine, but many of yours and other scholars, leading scholars and thought leaders who've been studying the emerging markets over the years. I call it a rigorous, comprehensive, and practical framework to measure the fundamental risks. And it's rigorous because it's basically a meta-analysis of all the academic research that lies at its core. It's comprehensive because one of the things that's really important here for me as I communicate about how I think about emerging markets to the world, I want to emphasize how it is multiple dimensions of risk. These institutions that I mentioned earlier, those are the fragility of those institutions represent really the core, deep down DNA-based risks in emerging markets that make it so interesting to study them. And it's comprehensive in that it's not just, are you an emerging versus developed versus frontier? It's a more complex, more nuanced conversation we know we should have. Certainly as scholars, we know we should have. And it's practical in the sense that I actually build empirical indices, empirically based indices that rank emerging markets each year over a 2-decade period across many, many countries based on each of these 6 different indicators. You'll get a sense of that in a second. I build the indicators. I happen to build the indicators in the book, not just for 33 emerging markets, traditionally defined emerging markets, but also 24 developed. And it's all public data. It's all hands above the table, a statistical analysis. Anybody could have done it. It's all very transparent and open. And then what I do in the book is show you that it can explain a lot of phenomena that are out there. In fact, foreign investor cross-country holdings, finance guy, that was my focal point. Why did I write this book? Well, a lot of good questions there, but honestly, my secret mission with writing the book was to compel people to elevate the quality of our discourse in industry and also scholarly circles about what an emerging market really is. I worry that too many scholars out there are easily manipulated and influenced by commercial vendors who are trying, or the World Bank or IMF, who are trying to artificially simplify our thinking. We should not be so susceptible. So what I do in the first sentence of the first page of the first chapter is lay out what I define as the emerging markets. What is common to emerging markets? They are what I call underfunded growth opportunities with problems. And if I could underline for you, I would put 2 triple underlines under with problems. That's the fragility of institutions part that I was talking about earlier. That is the signature. I thought in the decades leading up to this book is that too many thought leaders in emerging market space are obsessively focused on the up, 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 and growth, growth, growth. That is not the signature of emerging markets. It's not the growth, or not just the growth potential, but rather the concomitant risks that impede the flow of capital to fund those growth opportunities. That's the secret sauce. That's what emerging markets are, says I. So it's not just the growth potential. I wanted to elevate the discussion by talking about multiple dimensions of these problems that can matter. I also secretly wanted to poke fun at all the people that use these silly acronyms of BRIC, BRICS, N11, TIMP, CIVETS, MINT, and on and on and on. This, ladies and gentlemen, has got to stop. Scholars like yourselves should stop using those acronyms. We are better than that. We understand the nuances, and people in industry look to us to guide them on this thinking. All right, and so there you go. That's why I wrote it. So you ready? It looks like I'm looking at a few of you. I can see Mike. I still got his attention. That's good news. I still got his attention. Perhaps a few others. All right, so what are these indicators? Well, number one, honestly, number one is the first among equal. It's the one that, you know, the IMF and World Bank would typically rely on. How large is the market relative to the size of the economy? I call it market capacity constraints. You could also look at GDP per capita. Honestly, if you were to boil down the World Bank or IMF definitions, it's too simplistic. It's just GDP per capita. We know that it has to be more sophisticated than that. So in this measure of market capacity, I involve not only GDP per capita, but also market cap to GDP, both public and private, bond market capitalization. I also measure things, think of these as all data and statistics, turnover ratios. So it's not just how large the markets are relative to the size of the economy to support growth, but also how vibrant they are. How many new public issuances of stock are coming to the market as a fraction of GDP? Think of things along those lines. But that's just one measure. We also want to focus on the operational efficiencies, basically the plumbing of the markets. It's an investor-focused measure, but it doesn't have to be. I happen to make it that way. But it's looking at things like basically the frictions in the markets, brokerage commissions, transfer taxes, measures of illiquidity, the restrictions on different kinds of trading activities like short sales, the quality of the settlement system, basically the inner plumbing of the markets, how well they function, operational inefficiencies. Number three, foreign investability restrictions. A lot of people do think about this. Accessibility scores, registration rules, ownership limits, ownership restrictions, position limits, currency convertibility limits, withholding taxes, the existence of double taxation treaties or not. That's a whole big composite measure of all of these restrictions on foreign investor participation. Now, by the way, the first three I call hard constraints. That's how I describe it in the book. They're concrete. We can think about them, we can measure them. The softer ones are the next three. The first one is, I call it corporate opacity. It's basically governance rankings, the quality of accounting systems, aspects to in which companies manipulate the accounting systems, the existence of block holders and controls on block holders, dominant controlling block holder shares and interests, the existence of closely held shares. A lot of research lies behind all of these, that one for sure. I know there's some papers on the program that feature discussions about governance systems. Limits to legal protections is number 5. The restrictions on managers from self-dealing. from directors of boards of directors of companies from exercising their own private interests and rights, the existence of creditor information and registries, the existence of shareholder suits or not in these countries, prohibitions on insider trading, lax or robust. And then finally, number 6, political instability. A lot of measures of the quality of the political economic environment, constraints on government officials from engaging in wild and crazy policy swings, the existence of controls on corruption, government effectiveness, rule of law, things like the Heritage Foundation's Freedom Index. These are all things that go into this broad-based measure of political instability. These are the 6 that I featured in the book. Are they the only 6 that could matter? In chapter 12, the last chapter of the book, I talk about the fact that this should be an evolving thing. Maybe it should be there are new risk indicators that come along. Maybe some of these should become less important over time. Who knows? So what I do is I throw a bunch of data from research out there to building an index, a standardized index for each one of these 6 indicators for each of those 56 countries for each year from 2000 onward. And a lot of the data comes from existing academic research. You'll see an example here in a second. Lots of other useful data as well that I grabbed and harvested from other research or independent sources, all publicly available. Nothing secret, nothing behind the scenes, no proprietary data of any kind. And then I synthesize using a statistical technique, principal component analysis. It's basically boilerplate statistical techniques off the shelf, and I create indices for each one of these things. So here's some examples of some research for the operational efficiencies measure, some research studies. This is a survey of global payment systems to go with this research paper on liquidity. This is an independent consultancy called Elkins McSherry, part of State Street Investors, that did trading costs around the world. Here's a research study on short selling restrictions. Here's another measure of quality of exchange trading rules. Here's some measures, more papers on quality of liquidity proxies around the world. Imagine basically taking a bunch of research studies and data from them and throwing them into a bag and shaking them up using principal component. Oh, I even use some of my own research. Why not, right? Why not? Some of my own publications. And then I basically harvest the data for each of these countries. And you can see there's a number of different series that are comprised in each of these measures. This is just the one measure on operational efficiencies across all 56 countries. And what I do is I shake up the bag, and then I use principal component analysis. It's boilerplate, off the shelf, nothing fancy going on here. And then what you can see is that some of these measures have larger coefficients in absolute terms than others in terms of their importance and what they contribute to the first, second, third, or fourth principal component, depending on how many I use. I use very transparent description of how I use PCA to build these indices. Won't go into those details. And then out come these standardized indices. And so the first part of the paper basically is about setting this, the book is setting the stage. Then I talk about building the indicators. That's actually the heart of it. 6 chapters right in the middle guts of the book features how I painstakingly feature individual studies and data and how I build them into these risk indicators. And then I have a part 3 where I use 3 different experiments to validate them out of sample, and then come up with some conclusions and a whole bunch of caveats. So you guys ready to look at a few of these just to give a taste? This is what they look like. This is my favorite way to show it. They're called spider or radar diagrams. Remember, it's 6 different dimensions, and you can see here that the 6 different dimensions are market capacity constraints, operational efficiency, foreign accessibility restrictions, and you see they pan out from the middle. They go from the middle inside to the out. Negative numbers in the middle, positive numbers outward. Every one of these indices are bad country or bad score for a country, negative, good score for a country, positive. So if you have positive numbers or larger positive numbers in this standardized index, you are doing well. The market capacity constraints do not bind as much as for countries that have negative scores or worse negative scores. So you can see here, just for fun, rough cut, traditional classification, let's say World Bank classification of what's an emerging and developed market, the usual fancy ones. And what you do is you can connect each of the 6 dots on the developed side and the 6 dots on the emerging side. You see them? And they're unequal. One thing you immediately see is that the emerging markets have negative numbers for all 6 of these, and they're all more negative than any of the positive numbers for the developed set. That makes sense. In each of these 6 dimensions, emerging market countries typically score less well. Market capacity constraints bind more. Operational inefficiencies are worse. Corporate opacity is greater. Political instability is higher. So they have negative scores, worse scores. What's interesting to me, and I feature this, is that the magnitude of the separation between traditional developed and traditional emerging on some dimensions like operational efficiencies and governance are dramatic. But in terms of others like limits to legal protections, the differences, right, are not as great. This is something that the previous literature, I mean, we never really compared across these different dimensions. And so to me, it's the differences across countries in each of these 6 different dimensions that make it interesting to study, and of course, over time. So here's a picture. Look at this with me for fun. 4 interesting countries. Yep, I chose the BRIC, and I told you I hate those acronyms, but what the heck? So Brazil, look at Brazil. Brazil is almost look at it, it's almost like a perfect hexagon here in shape. It's equally bad or good, but mostly bad on each of the 6 different dimensions. There's no special aspect to it across the 6 different dimensions. By contrast, look at India, just below it, where it actually scores quite well in terms of its legal system to protect minority investors. The limits to legal protections are actually quite favorable, almost as favorable, probably better than in many developed countries out there. Same with operational efficiencies in India. Where India falls short is in terms of the binding constraints on foreign accessibility and this political constraints, the instability in the political environment. Russia looks like it's sort of oddly triangular and imploded. The market capacity constraints are not so bad. Honestly, I know it's hard to imagine, according to the data, remember it's hands above the table, the limits to legal protections are bad or no worse than the typical emerging market, but where it separates itself is really in terms of poor scores on corporate governance and corporate opacity. China looks like a squashed football here. What's interesting to me about China, and this is a snapshot in the middle of the sample, okay? It's just a snapshot for the 4 countries in the middle of the sample. China, it actually, the headline to me, that's not what people see when they see this, but the headline to me is how well it scores in terms of the market capacity, the operational efficiencies, and even the foreign accessibility is actually more generous, more open than many people give it credit for relative to other emerging markets. Even the legal protections for minority investors are actually pretty favorable. It's the corporate governance scores that just fly off the table, where the scores in China are worse. How fun. Here's an overall ranking by country. This is across the 6 dimensions. I'm going to do this for a reason. Remember, it's not from, I don't like to answer questions about what's above the line, what's below the line. What do you see here? The worst country in the scoring here across the 6 different dimensions on average is Venezuela. It's like off the charts compared to almost every other emerging market. Then there's a whole bunch of others and they slowly grade towards 0. What's interesting is countries like South Africa, Israel, now, yes, MSCI has now graduated Israel to developed market status. But what this says is the data give it validation for that. And then there are some other countries that are probably near graduation, if there was such a thing as graduation to developed market status. Now watch this with me. Mike, I'm seeing you. Everybody out there, I'm now going to keep and preserve this overall ranking because I want to show you now each individual ranking by score, by sub-dimension, while I preserve the overall ranking. Now have a look here. There's market capacity constraints. You can see that it's correlated, but not very well correlated with that overall ranking score across emerging markets. Typically negative, some exceptions, Taiwan, Korea, Malaysia, South Africa, but most of them are negative and not separating as much. Remember, that's the traditional way we separate emerging markets. I think we should be more sophisticated than that. Operational efficiencies is weird because it's almost like, though there is a monotonic pattern here across these countries, as I promised you, it's almost like bimodal. There's two big clumps of countries there. Fascinating. Foreign accessibility restrictions, very correlated with the overall score. But again, there's this big clump down here, and then it becomes uneven up here. And corporate governance is also almost like a step function from big negatives and then to zero or slightly positive. It's almost like two big groups of sub-countries across the 33 emerging markets. Limits to legal protection is, again, correlated with the overall score, but it's almost like the tails in the overall ranking that matter. And talk about tails, political instability really feeds into the very lowest scores. It's a very strong influence on the overall score, political instability. Maybe that doesn't surprise many of you. Of course, they evolve over time. This is the snapshot. The latest score I have is 2018. These are the ones I'm going to use for my forecast here in a minute. This is China. Now watch, keep your eyes on China. We're now going to go from 2018 backwards in time, backwards. What should be happening to this? Well, you already saw the earlier score for 2012. Now watch what happens. We should think that China has progressed and it should have pushed away from the center of the spider diagram. Is that correct? Let's go backwards in time in 4-year intervals. That's the one we saw, remember it? And look at it shrinking backwards in time. That's exactly what we would predict. China has made tremendous progress on each of these 6 important dimensions. And look at this. This is the overall ranking, political stability. That should be changing organically over time as the political environment is evolving, right? So there's 18, 14, 10, 6. Venezuela is still pretty bad. Here in 2002, Pakistan and Nigeria scores particularly poorly, as does Russia, whereas it didn't relative to others, perhaps later on in the sample. So, all right. I'm looking at the clock, and I want to give you the headline here on the predictions. So in the book, I'll give you a little taste for what I did in the book. Obviously, creating these indices is fun and interesting, but it's a purely academic exercise unless it can do something, explain something, or predict something. So what I did was I collected data on institutional equity holdings around the world involving almost 5,000 institutions, asset managers, asset owners, sovereign wealth funds, mutual funds, public pension funds from all over the world. And I collected up this data to see how they invest in the emerging markets, at least across the countries in which they invest. It's called FactSet Ownership Database. It captures about $23.5 trillion in assets under management. So that's a fraction of the pie. And about 6.3 trillion of that 23 trillion is what they invest overseas. About, a quarter of it they invest overseas. That's typical. You know about the home bias. Home bias is the 75% that stays at home. 25% is what's invested overseas. The foreign bias is looking at what institutional investors invest overseas by country and calibrate it against the relative market capitalization of each of those countries. And what we're interested in is seeing whether institutional investors favor some countries more than they deserve relative to their relative market capitalization. Are they favoring, tilting towards, for example, Malaysia and, for example, disfavoring countries like Russia, for example, relative to its market capitalization. It's these over and unders that I'm interested in trying to explain. I call it the excess holdings or the potential biases. So the Morgan Stanley Capital International All Capital World Index market capitalization weights are the anchor. That's the basis. Here is a snapshot of the data for you, just to show you what institutional investors did. This is using 2012 data. This is what was featured in the book. And you can see that there are some emerging markets that are favored by institutional investors. Taiwan, South Africa, Israel. They invest more in Israel than the relative market capitalization or importance of Israel. Most emerging markets are underweighted by institutional investors. They tend to overweight developed markets and underweight relatively emerging markets. And you can see most of these are negative, but they're all over the map. Turkey is out of favor. India is out of favor. Indonesia is out of favor. Russia is out of favor. The biggest sticks out like a sore thumb. The biggest one that is out of favor is China, almost minus 8% underweight. It's not even, I can't even show you on the chart and still make it look interesting. Huge underweight. Many people have, maybe you're seeing this for the first time. So these are the simple regressions in the book, chapter 10, where I'm validating, and I evaluate whether the 6 indicators can explain these over and unders that I just showed you. And the answer is, for the most part, they do pretty well. Some of them better than others. Collectively, they can pick up somewhere on the order of about 20% of the over and under weights relatively across the countries. It actually does pretty darn well. Shouldn't be a surprise because this came out of research that was probably validated independently in peer-reviewed journal articles. So, I mean, it shouldn't be a complete surprise, but it's interesting to show in this sort of simple setting just how important, like, for example, differences in corporate governance can be. A 1 standard deviation increase in the quality of corporate governance going from, say, Philippines to South Africa, according to my measure, can explain about 1% of the relative underweight or overweight favoring South Africa overall. I mean, it's fascinating how well it actually does. This is an assessment of the overall explanatory power. You can see this is like the actual holdings on the left, the y-axis, the predicted from the 6 indicators on the x-axis, and that's sort of like the scatter plot of points for the regression. The line is the regression line that I was just showing you in that table, and you can see the R-squared is about 20% overall across the 6 indicators. And of course, what's really interesting, of course, where your eye goes is not to how closely compact the cloud of points is around the regression line. That's what you should be doing. But you want to look at the exceptions. And man, oh man, is it hard to explain the enigma that is China. China really has a huge underweight, and it seems to belie the magnitude of what we can explain using these 6 indicators. All right. Now, I hope I'm getting a bunch of you to start thinking about this with me. That's the book. That it is in a nutshell. There's a fun chapter in there. I call it the bonus chapter, number 11, where while I was writing the book, late 2013, it was published the first edition was published in 2015. But in 2013, I was on sabbatical writing this book. And in the middle of that year was what we remember, many of you might remember, was the taper tantrum, where basically the Federal Reserve Board of the United States, the central bank, decided to start to normalize interest rates. And that led to a massive capital outflows out of emerging markets being attracted back home by the relatively higher interest rates and yields that people were expecting at home. There was just this massive outflow. And of course, hue and cry across the emerging markets for the dislocation that was caused by the Fed. So in chapter 11, while I'm writing the book and building these indicators and doing all this work, I tried to predict the outflows across the different emerging markets. And you know what? It does pretty well. So here I am, ladies and gentlemen. I've continue to update these indicators, at least up until 2018. I didn't know what was going to happen in 2020. You've seen the data now with me. I've got data on these indicators as of 2018. So the question I ask myself in preparation for this talk is, how well do those 6 indicators explain that huge dispersion across emerging markets in those capital outflows? And what the heck, why not even look at the returns? Not just the outflows, but then the return, the rebound inflows, as well as not just the crashing of the returns in March, but the rebound all the way through to October. And what's the answer? Not so bad. What a surprise. The quality of the institutions that define the core risks underlying these emerging markets can explain a lot about what happens, even during an unexpected COVID-19 shock. So remember this picture I showed you earlier? Imagine this is going to be on the left-hand side of my regression. We're going to call it a prediction because my indices were built as of 2018. I'm going to try and explain these. And here's what the regression looks like. The actual outflows from February through April across countries is on the x-axis. The predicted is on the y-axis this time. I flipped it. And the cloud of points around my prediction line, pretty good. 24% R-squared, 24% predictive power. That's pretty good. Again, China, which did not see major outflows in March, is not what I would have necessarily expected. Even though my scores for China are pretty good, I still would have predicted outflows, and there weren't any. That's hard on my prediction model. Peru also broke ground, but I did pretty well in terms of predicting outflows in Brazil and India. Surprise. What about the rebound? Well, not as good on the rebound. The cloud of points is a little wider around the line, and the R-squared on the rebound inflows from April, May, June, and July is only about 11%. But still, it's 11%. Not bad. Remember this picture I showed you? Mike, remember that picture earlier? There's the crow crashing, and there's the rebound, and the huge dispersion in the rebound up through October. Well, how well did I do in predicting the actual emerging market returns across countries through March 31st? 57%. That's remarkable, remarkable precision. Now, honestly, the truth is the actual is quite compact in this range, reasonably compact in this range. That's not where the big dispersion is. So maybe this is not that tough a test. I don't know. I want to give myself a pretty good score on this forecast. What about the rebound in the returns? 33%. That's where there's huge dispersion in the rebound, the magnitude of the rebounds. 33% of the rebound can be simply explained by the core fundamental indicators. Look, I'm not saying that I've cracked the enigma, the emerging markets enigma. I say this in my book too. I still haven't, and COVID-19 hasn't helped to crack the code. Of course not. But again, the point of emphasis here is we need to think about emerging markets in a more sophisticated way than we all have. Push yourselves harder. Remember that there are multiple dimensions of risks. We should think more sophisticatedly about emerging markets, not simply whether it's above the line or below the line, it graduated or now it's submerging. Those kinds of conversations are too simplistic. And then that's what I really want you to take away from all of this. And maybe this COVID-19 thing is interesting. I don't know. So I'll stop sharing. I know I'm supposed to leave about 10, 15 minutes for any questions.
Yeah.
I'll be very disappointed, Mike Pung, if you don't ask me at least one. Put the pressure on you, my friend. But are there any questions out there that would be fun?
Thank you very much, Andrew. Excellent.
Thank you, Lourdes.
Very few academics put themselves to test their findings. So what you have done is remarkable.
Are you recommending that I shouldn't have done that?
No, you should. No one does it. And then when there is a difference, you say it was a black swan. So that's it.
Yeah.
Anyway,
say, it's a black swan. We'll never be explaining.
Yeah,
it.
exactly. And even
but
a black
out, not so bad.
Exactly.
So
excellent.
bad.
Excellent. You passed. You got honors in the examination.
Thank you. Thank you.
So
who would like to come in and throw a question over here?
Mike.
Mike, come on, Mike.
Yes, Andrew, excellent presentation. So good seeing you after so long. But I know you always will come out with good work. Show us the very first one about the DMs outside and EMs inside. The before you do the 6 dimensions.
Yeah, before the 6 dimensions.
Yeah,
I showed something.
You showed the slide with DMs outside and EMs inside.
Let me see. I'm going to go back.
It's
this one right here.
Before that, yeah, it's this one. This one. No, next one. The one with
this one. Yeah.
Okay. Now this is so interesting, but I just want to point out the closest distance is the limits to legal protection.
Yes.
Right. That means this is the easiest area to reform, as long as you have sufficient political will that can translate into corporate governance reforms. So that is so interesting. I mean, the other areas, they are so far away. I hate to say hopeless, but just very challenging to reform.
Yeah, I love the way you're thinking. I love the way you're thinking, Mike, because you're thinking like, I launched the book at the Brookings. The Brookings event attracted a lot of policymakers from IMF World Bank world. And of course, they have there's a lot of political turmoil associated with doing these kind of rankings. I'm sure you can imagine. But, I'm an academic, so I can just say what I want. A lot of the people in the audience among policymakers are thinking like what you are now. I don't, right? I'm not a policymaker. So they were thinking, gosh, where can we engage in some reform activity to really get some wins for our country? And you saw it exactly. You saw, hey, the effort put towards creating a more robust legal systems to protect minority investors or companies that are doing business in a lot of these emerging markets is a place where it's a small gap. Maybe this can really translate into a positive ROI for the country, right? Whereas, trying to overhaul the governance system is like hopeless. That's what you're thinking. I don't think like that, but I like that you think like that. I like that this is drawing that out of you. A lot of this work on limits to legal protections comes from the research by, I'm sure you know a lot of the research by Laporta, Lopez de Solana, Schleifer, Vishny, Jankov, a lot of them using these, in fact, they were very influential on the World Bank's World Governance Indicators, the building of it, Simeon Jankov, who became later Prime Minister of Bulgaria. But a lot of them were featured in this legal measures that are featured here. Fascinating. Thank you, Mike.
Yeah, it seems low-hanging fruit. I mean, so
yeah,
right. So that makes a lot of sense. So thank you. I'll take myself.
Fantastic question, Ravi. Good to see you, sir.
Andrew. I just want to show you that I've also been paying attention, not just Mike.
Not just Mike. Thank you, Ravi.
Now I had a very different reaction to the same chart than Mike's, and my puzzle was, why are the developed countries so awful on limits to legal protections that they come almost to so close to the developing, to the emerging markets, that to aspire to match them on the dimension on which they are the poorest, maybe should not be our aspiration, but to try to match them on the dimension in which they excel. So why is it that they are, I'm looking at the glass half empty, not half full?
I love it. I love it. So the book is all about emerging markets, but of course I purposefully and by design created these indices uniformly across the entire spectrum of countries. In every one of my graphs, I show them like this. The rankings always look like this in the book and on the website. And they're always focusing on the 33 traditional emerging markets. But of course, I have these for all the countries. I think there's only one graph where I show you all of them. by the way, ladies and gentlemen, I'm happy to share these data. I share them with scholars all around the world who can want to use them for any kind of research that they want to do. What you see is there are a number of traditional developed countries, Ravi, that get very poor scores in terms of hostile treatment of foreign investors. Traditional developed countries that score rather poorly. So the headline of the story is not so much that the emerging markets do so well, as much as a number of our traditional developed countries score so poorly in terms of hostile treatment for minority investors from overseas. That's really, that's the interesting part of the story.
Yeah. Yep.
And this harkens back to the Laporta Lopez de Solana Schleifer Vishny, if you recall, makes a big distinction between civil and common law countries. And of course, there are many developed countries in the civil space, a lot in Europe, and they score typically poorly in terms of these limits to legal protections.
Interesting.
Fascinating
Thank you.
stuff.
Thank you. Yeah.
Yeah. If I may, I saw that you had increased the corporate opacity
Yes.
indicator had improved. Yeah, I saw that for China. Yeah, and then that has to do, I mean, Ravi, for
Look
sure.
at this.
And yes, a lot, because, and in general in emerging markets, when I started doing research more than almost 30 years ago now, it was impossible to find information about corporations, and this has definitely improved over the years.
Well,
and,
you know,
now,
it's true, Lourdes. China has taken this on as part of their mission. The Chinese Securities and Regulatory Commission, as well as each of the Shenzhen Shanghai Stock Exchange, have created special governance boards, and they created almost like an incentive compatible systems for a lot of the corporates to try to aspire to, with the logical goal that they would be able to secure financing from shareholders and public investors on better terms than they would otherwise. They understand the importance of investing in better governance technologies. And you can see here, thank you for noticing this, you can see here that there has been a payoff here, right? There's a positive payoff for that country in terms of their investments in governance technologies. That's my take.
Also, we had data this year in the EMI report about what you have mentioned, that there is very little foreign ownership in the stock markets of emerging markets. But China wants to change that. And because they want to change that, you have to be much more transparent, for sure.
Exactly.
Okay.
Exactly,
So
Lourdes.
Yeah. Daniel is here. Maybe you want to also share with us.
How are you, Daniel? Greetings
Hello.
to Vancouver, my hometown.
Really?
Yeah, can you see the poster behind my head?
Yeah, I'm looking at it now. I didn't.
Born and raised, sir.
No kidding.
Cheers.
Well, I'm sitting here in Olympic Village, which probably was nothing when you were here.
No.
No. My question is about political instability and,
Yes,
and
sir.
the use of those Polcons and Polity4s. Are those measures biased towards democratic systems and overrate them?
Yeah. I think it's a great question. Are you familiar with the work of Witz Hennes?
Yeah, I've just used those measures.
Yeah, I find it fascinating. Financial economists like myself have been far too long ignoring the importance of that work among these international business scholars like Witz and others of you that are out there. I've heard that about the biases because it really is embedded in the democratic ideals. And when I've gone on the book tour in China, when I showed poor scores on political instability for China, I mean, you think, what? That doesn't make any sense, right? China, if nothing, China's been the most politically stable of any country. But you have to remember that what goes into the making of the sausage in those political constraints measures is what Witz and the other scholars call political fractionalization. So they look at just how the coalitions in the governing bodies like Congresses and parliaments are built and how dispersed they are. The more you rely on coalition type governance, the more it is that you are unable to engage in wild policy swings. So the problem of a unitary house like the National People's Congress in China is that, you know, the governance of that, the executive committee can engage in policy actions without the encumbrance that inhibits policy change, right? So that's where the logical reasoning is. But you're absolutely right. It doesn't work perfectly, does it? It doesn't work perfectly everywhere.
Well, thanks.
That's great question, actually, Daniel. Thank you for raising it. I appreciate it. I think we must be coming near time. I don't want to encroach on my my colleague Denise, but thank you so much for inviting me, Lourdes, Chris. I had so much fun preparing for it, and you can probably sense from my my words and my enthusiasm how much I had doing this. I'm thinking I'm going to write this thing up and submit it to some journal. There was so much fun to write and prepare. So cheers. Thank you, guys. Thank you, everybody. Have a great conference. See you.
Thank you so much,
Thank
Andrew.
you so much, Andrew. When we share the presentation, when you share the presentation with us, both Chris and I were in awe, because as you can imagine, these are times in which deans of faculty like Andrew are super busy. So thank you very much in a super busy schedule, in a super busy and complicated time for all of us, for all the universities, to make time to prepare an excellent and outstanding presentation, and for putting yourself to exam. So you passed the exam. So thank you very much.
Cheers.
Thank you. Thank you. So we have here with us Denise Odaro. She's a double Ivy League, one Ivy League from the other side of the Atlantic. So she graduated from Cambridge and then from Johnson MBA. So thank you so much, Denise. It's Saturday evening for a young mother of two very little kids. Not easy to make yourself available. Very committed Cornellian. Thank you very much. So Denise is the head of investor relations at the International Finance Corporation, and she has received many awards as the best of her kind. So thank you very much, Denise, for being today with us and for your commitment to Cornell and to this conference. Thank you. Please, the floor is yours.
Thank you very much, Lourdes. Ladies and gentlemen, greetings from Washington. It is my utmost pleasure to be here today. And I'd like to thank the EMI team in particular for putting this together in spite of the challenges that we've seen this year. Also, what an auspicious day with celebrations going on across the US. And you can probably hear the honking from the streets of downtown Washington where I live. So this era and the theme of this conference is so salient because obviously digitization, technology has played a phenomenal role. And so thank you for this wonderful opportunity to connect on such a topical issue and one that's ever more critical since the outbreak of the coronavirus pandemic. Before I go on, and I really no slides today, I really want this to be almost a personal connection with all of you, the participants. Let me start off by explaining very quickly what I represent and what IFC is. So starting off, you know, the World Bank Group, which was founded after World War II, precisely after the war to refinance Europe and restructure Europe, rebuild. And 9 years later, it was decided that the private sector was key to development. And for that reason, IFC was created. And so we've been over 60 years in business, and IFC, which I hope a lot of people know, but it tends to be that people know the World Bank and don't know that the World Bank is made up of various institutions. And there isn't really one institution called the World Bank. In any case, so IFC, our business is loans and equity investments to emerging markets. And in particular, this is our specific focus is private sector. And so when you read about loans to sovereigns in the newspapers, that's from the sister institution, the International Bank of Reconciliation and Development. And if it's a loan to a private sector company, it's from IFC. And so as Lourdes said, I head investor relations for IFC. And what I do essentially is raise $17 billion a year, which we then on-lend to private sector companies. So about 14 years ago, around this time, it was autumn in London. And at the time, I worked as an associate at General Electric, the capital markets desk in London. As you pretty much all know, GE, obviously one of the founding members of the Dow Jones. And I remember just after lunchtime one day, receiving the email that I'd been accepted on the MBA program to the Johnson School. I was thrilled. I was absolutely thrilled. And I had had a Facebook account for maybe 3 months. But of course I went on there and I made a post about, go into Ithaca. And of course, this is before the term viral was coined. I don't want to say that's how old I am because I'm not so old, but I don't consider myself young either. In any case, this was the same year that Clive Humby, the British mathematician and data scientist, also proclaimed that data is the new oil. It's valuable, he said, but if unrefined, it cannot really be used. It has to be changed, he says, into gas, plastic, chemicals to create a valuable entity. And that's what drives profitable activity. So data must be broken down, analyzed for it to have value. Perhaps there's no better example, in fact, of such use of data to create profitable activity than the very rise of Facebook I alluded to. So that in itself, and the fact that the tech sector, if you've been following the markets, is now the sector that holds the most value in the stock market. In August this year, ExxonMobil, which joined the Dow Jones almost 100 years ago, was removed from the stock index. Now, it was the oldest member of the index. What's replacing these institutions that were once the bedrock of the global economy? Increasingly, is global technology firms that represent the significant share of major stock indices. ExxonMobil was also once the most valuable company in the United States for most of the 2000s. And as recently, technology, and as recently as 2011, when it hit a market value of just over 400 billion. So Apple overtook Exxon in 2012, and much of the technology sector followed thereafter. I mean, what company replaced Exxon in the Dow this year? Well, it was the enterprise software company, Salesforce.com. So over the past few months, our world has transformed, and IFC, as a development finance institution focused on the private sector, our role has become even more critical. To meet the Sustainable Development Goals by 2030, which is the 2030 agenda that was created by the UN and the 190 odd countries, we have a huge funding gap. And the pandemic has exacerbated this with other challenges that we need to address if we're to achieve these goals. Developing countries still face a significant gap in development outcomes. And these gaps require disruptive solutions, innovative thinking, looking at the typical constraints to investing in potential opportunities, attracting the private sector, and supporting an environment for technological diffusion. So if we are to achieve this flagship ambition of the Sustainable Development Goals to end extreme poverty by 2030, improved digital cooperation will need to play a vital role. So digital technologies are at the forefront of development, and they provide a unique opportunity for countries to accelerate economic growth and to connect citizens with services and jobs. In times of crisis, from natural disasters to pandemics, such as the coronavirus, COVID-19, that we're currently experiencing, digital technologies are what's keeping people, governments, businesses connecting. It's the oil in the system. So digitization can aid emerging market economies to skip traditional stages of development, from digital banking to blockchain, telemedicine. I mean, in some ways, you can argue that the pandemic, in fact, has accelerated that, even in the developed nations. So at the end of 2013, if you were to look back, half of the world's population was still without internet access, half. And the vast majority, of course, in emerging markets, developing countries. Of the 25 least connected countries in the world. 21 of those are in Africa. But the pace at which the internet is growing in sub-Saharan Africa is also one of the fastest in the world. So fostering digital inclusion is of paramount importance. 1 billion people in the world cannot prove their identity. Just imagine that, not being able to prove that you exist. And this limits their access to digital services, to opportunities. Throw into that mix the gender gap, which, as you probably know, is still wide in the least developed countries, where women are 33% less likely to use the internet than men. And they're also 25% less likely to know how to leverage digital technology, just for basic purposes. South Asia has the biggest gender gap. Women there are 51% less likely to use mobile internet than men. So with the opportunity of digital technologies to expand access to markets and opportunities, helping countries invest in digital development is an important aspect of the World Bank's group to our work to reduce poverty and inequality. The numbers speak for themselves. The digital economy is equivalent to 15.5% of global GDP, growing 2.5 times faster than the global GDP over the last 15 years. So research shows that a 10% increase in mobile broadband penetration can result in 2.5% of GDP per capita. And looking at a time period between 2009 and 2015, internet bandwidth grew 20-fold in Africa, and mobile broadband alone supported around 3.8 million jobs in the continent. Job creation is obviously a way out of poverty. And not only is it a way out of poverty, to a large extent, it is what feeds what our basic needs are, right? When you think about Maslow's hierarchy of needs, how do you achieve those basic needs that are in fact human rights? So what will it take in a post-COVID environment where digitalization efforts can accelerate across the globe, but in most developing and emerging economies, there isn't that, they do not currently possess the right tools and environments for that. So what will it take for countries to leap and reap the benefits of this digitization? Well, closing the global digital divide, if I think of it that way, new technologies are spreading rapidly around the world. And as I said, 4 billion people still lack access to the internet. Preparing for the jobs of tomorrow, innovation is radically changing the nature of work. I've worked from this seat in what is my family's living room, where everyone is now banished to different rooms in the house. I've worked here since the 13th of March. I never thought that was possible. And I normally now, I could be speaking in a conference in Korea at 9 a.m. At 3 p.m. I'd be speaking to Parliament in the UK, and I could be speaking in New Zealand in the evening. And that was pretty much not something that, even though it was possible, it wasn't done up until now. In any case, developing secure, reliable digital systems as the world is going digital, strengthening the capacity in areas like cybersecurity and data protection has become more important than ever. So let's add that together. A robust digital economy means more employment opportunities, increased productivity, better access to products and services. So given rising global youth and unemployment in many of the fastest growing countries by population, the opportunities offered by digital entrepreneurship are particularly important for the jobs agenda. So during this crisis with COVID-19, digital technologies are keeping people, governments, businesses connected, as you know. But in emerging markets, we were already moving towards digital solutions now. Sectors like e-commerce, health tech, online ed, bringing innovation and a change that's here to stay post the pandemic, hopefully. Adopting new technologies can also allow emerging economies to leapfrog steps in the traditional development ladder. So for example, emerging market nations that had never established a telecommunications landline infrastructure or a retail banking system could bypass those development stages due to the proliferation now of mobile phones and the innovative financial services now available to them. Yet, the path from technology adoption to market creation is not obstacle-free. So I don't want to make it seem like this is something that's just easy to get. The penetration of adopted technologies in developing countries is often too low to sustain new markets that depend on them. And also, of course, technology is just not sufficient to create fully functioning markets. It needs to be complemented by government, regulatory policies, highly dependent on infrastructure improvements, etc. So none of these obstacles, thankfully, are insurmountable. And this is why I'm grateful for opportunities such as this conference to discuss obstacles, challenges, and ways that we can mitigate those. So as a development finance institution, we have a big role here. IFC and other development finance institutions aim to use technology to accomplish the United Nations SDGs. So I alluded to this before, but digital technologies have also brought new and very serious concerns. Around the world, people are increasingly, and rightly so, worried that the growing reliance on digital technologies has also created ways for harm and irresponsibility. So I want to highlight just some of the key challenges and then wrap up. But so firstly, virtually every day brings news stories about hatred being spread on social media, invasion of privacy, cyber attacks, etc., violations of rights, in fact. There are many examples of digital technologies being used to violate rights, undermine privacy, polarize societies. We've seen the worst of it this year. The use of artificial intelligence to produce deep fakes, audio and visual content that convincingly mimics real humans. This complicates the task of telling the truth from misinformation. The world is suffering from a truth deficit disorder, in the words of the UN Secretary General. The right to privacy also has become particularly contentious, as digital technologies have given governments, private companies, vast possibilities for surveillance, tracking, monitoring, some of which are invasive to privacy. So I urge you all to take note that the ultimate purpose of digital technology should always be to improve human welfare. Secondly, many people have been left out of the benefits of digital technology. More than half the world's population, like I said, still lack internet access, still lack affordable access to essential services that can be provided through technology. Right? People who lack safe and affordable access to digital technologies are overwhelmingly from groups that are already marginalized: women, the elderly, those with disabilities, indigenous groups, those who live in poor, remote areas. So many existing inequalities in wealth, opportunity, education, and health, these are being widened further. Thirdly, cyber attacks. I'd mentioned this before, but the massive data fraud and threat have ranked for 2 years in a row among the top 5 global risks listed by the World Economic Forum. More than 80% of the experts consulted in that survey expect that cyber attacks, theft of data, money, disruption of operations to increase yearly. And there are 3 recent examples that illustrate the concern. In 2016, hackers stole $81 million from the Bangladesh Central Bank by manipulating the SWIFT global payments network. In 2017, the malware NotPayra caused widespread havoc. The shipping firm Maersk that company alone lost $250 million. In 2018, by one estimate, cyber criminals stole $1.5 trillion. That's an amount comparable to the national income of Spain. Lourdes can attest to that. As artificial intelligence advances, the tactics and tools of cyber attacks will become more sophisticated and difficult to predict, of course, and including the ability to pursue highly customized objectives. We need to be able to adapt in real time. There's no single approach to digital cooperation that can address this diverse spectrum of challenges. And of course, like I said, the pandemic has hit the poor and the vulnerable the hardest. I mean, it's threatening to roll back the development gains that we had already made. An additional 73 million people are expected to be pushed into extreme poverty this year alone. So the massive unemployment generated by COVID-19 highlights the importance of jobs and economic transformation, for which now a platform of that is technology. So after months of COVID-19 restrictions, it's tempting for us to talk about returning to normal. Everyone wants to return to normal. But what does that mean? Back to normal for some people means living without access to critical services, living below the poverty line. The pandemic has revealed the lack of resilience in the old normal way of doing things globally. And across the globe, we've all been affected by this. So we should take this time to really consider rebuilding better. Rebuilding better is about achieving resilient, inclusive, and sustainable recovery. We should all take this juncture as things reopen to reflect on the need to change what might have been accepted as normal, but has now been proving unable to withstand shocks. So to learn from the lessons of the past and lay the path for sustainability. And I'm always on that. I'm the choir mistress for sustainability, always singing that hymn. So as an institution, IFC, we have a disruptive technology department is one of the strategic priorities that we have. We invest in venture capital, equity, loans to this sector. We will continue to develop additional products to build these markets. And looking ahead, the collective response amongst us all here today in this conference can include identifying promising investment opportunities, funding these, but making sure that we are in fact being mindful, again, of those challenges that I mentioned and the inclusion of all and respecting rights. You should all consider this an unprecedented time as an opportunity to shape the future, not just respond to it. As future leaders, I urge you all to expand our collaborative role with the goal of increasing impact using technology post-COVID-19. I hope that today's summit provides you with deeper insights into how we can arrive at this outcome using technology as one of the key tools that we possess. So it's clear that data really is the new oil, and the main impact on humanity isn't how the tech giants are monetizing our attention units, but how data can actually improve lives. Oil causes pollution, yet it was also responsible for lifting a majority of the population of the world out of poverty. So we must now manage data in the same way, and using those lessons learned, how can we advance humanity without the pollution? Thank you all very much.
Thank you. Thank you so much, Dennis, for this very inspirational presentation. We had Andrew defining emerging markets, and now you reminding of all of us of the importance of digitalization. So then, any questions? If there are no questions, I wanted to ask you one thing. So, thank you, Andrew. So, Andrew, please go ahead. And then I'll
You go first, Lourdes. I'm patient.
Thank you, Andrew. So, Kristalina Georgieva, the chair and the managing director of the International Monetary Fund, the parallel institution or your parent institution, has been very outspoken during the COVID crisis. There was, from the emerging markets point of view, there was a criticism often of the IMF saying, are you part of the solution or are you part of the problem? Clearly, this time, the leadership of the IMF has been incredible, asking for debt relief of many countries, giving new lines of credits. So my question is, how has your work at IFC changed? What have you done? What are the main measures that have been implemented from the IFC in these very hard times?
Terrific. So when COVID hit in March, we were still thinking that, I think the first thing was the private sector is key. We have to figure a way to support our clients to ensure that people have jobs. So what we did, and that credit lines were open. So the first thing IFC did was commit 4 billion to a program, our COVID response. And 2 weeks after that, we increased that to 6 billion. So this is part of a 14 billion initiative by the World Bank Group as a whole. But as I mentioned, our sister institutions are doing it for sovereign and public sector, but IFC's 6 billion is exclusively for the private sector. So that 6 billion is under four different facilities. So we've spread it out 2 billion to the real sector. And then we have a working capital solutions one. And then we have trade finance, and then the other to climate. And this is really for a lot of it for our existing clients. And we've had about, we also, the other thing that we did was we set up not a payment moratorium for our clients, of which surprisingly, we have not even seen that many clients come back to us asking for that, but that option was there. And arguably, when you compare this crisis to the GFC, you know, it really, if anything, has strengthened the reputation of the development finance institutions. We are, in many cases, counter-cyclical. This is where we shine. And the fact that not only have we done set aside this amount of money fast track to emerging markets, private sector, we've also provided advisory to help. I mean, just I talked about gender, which is one of our priority areas. We have a toolkit for employers to provide childcare so that people whose children were not able to go to school could continue working. And, you know, again, this is a pandemic that has hit women even harder. So one of the things that we looked at was providing support for women to facilitate other sectors like, you know, the equivalent of Uber, but for women only in certain parts of the world where that was an issue. So IFC really, I think I'm very proud to say that this is a pandemic we've taken very seriously. We've provided support and continue to do so with our clients. At the core of that in the end remains sustainability, right? And that everything that we do now, like I said, as we rebuild better, is again, taking that stream, that core DNA of sustainability into it.
Andrew, please, your question. Thank you.
Denise, I just wanted to say how proud we are here at Cornell to know you are one of our own. The work you're doing is incredible. I was, when we heard that you were Person of the Year by Environment Finance magazine this year for all your hard work on the green bond principles. I mean, just incredible work, and it just great source of pride. So here's my question. What we're talking a lot about here in some key work with the Atkinson Center on Sustainable Finance, sustainability, is another of the SDGs focused on biodiversity and the biosphere. So there's a lot of talk about green and climate, but I know there's a high priority at IFC, World Bank's, and IMF circles on the blue bond world, the blue market, thinking about the biosphere and degradation of the biosphere, intricately tied, right, with climate change. So
Yeah.
I'd love to hear your thoughts. I bet you're ahead of the curve on this as well, and I'd love to hear your thoughts on.
First of all, Andrew, thank you very much for the compliment. You know, I am only here today because of everyone has played a role in any little success that I have celebrated. And of course, the Johnson School is a huge pillar of that. So I'm a proud JGSM, I carry that card wherever I go. So the talk of sustainable finance, this is very key. And I want to draw this, make sure that all the participants are well aware of this. And mark my words, there will come a time, not long from now, that no one, institution or individual, seeking to finance a project will be able to access capital without having environmental, social, and governance embedded in their project and their profile. Without a doubt, take it from me. And I would say this is almost comparable, that there was a time when, way before any of us, our time, people lent money without thinking about, oh, what is the credit rating of so-and-so, right? So it was all gentleman's agreement until there was oh, perhaps we should be checking these things. This is where we are. This is fundamental. Now, on the finance side, unfortunately, the way that things have, the way that our current economy and society is built, I would use the word, to me, is that it's become perverse. When you look at capital, right, at the very base of it all is natural capital. These are things that are invaluable. We did not create them. We met them here. The natural resources, water, the fossil fuel, it's finite, sunlight, etc. On the next level, you have, us, we essentially, the social capital. And then what is built on that is this, essentially, the fiction that we've created, which is finance, that I can give you $10 and you take this piece of paper and say, this has worth, and everybody believes it has worth, and it does. It's a fiction that we've created. Now, think of it as a pyramid, what really exists and what we created. But what we created is now the bigger part of the pie. So really, we need to go back and readjust not only our values, but our models, how we've been pricing things, right? We've been pricing, just take for example, again, like I say, water. So you could have a project, you've needed water for this project, and there's a finite amount of water in the well, which you've been extracting from. Nobody's put a price to that. And nobody's even taken into account that that's going to run out in 2 years. Your bankers have been giving you money based on the fact that you will always have access to something that's not always going to be there. Anyway, that was illustrative. Sustainable finance, the bond market, which is the largest debt market in the world, of course, is now taking a hold of this. So the role that we've played, and I at IFC and within the Green Bond Principles, I've chaired this committee now for the last 8 years. It's phenomenal. There is no other market that has grown so quickly. And there's a reason for that. Reallocation of capital is key. We need to basically now look at how capital is allocated. And I gave the example of the Dow and how things are changing, right? Who would have thought? So essentially, the sustainable finance is here to stay. That's my #1 message. So those who are not on the bandwagon, start getting on it. Second thing is, it's not even a question of, should we be discussing this? Is it important? It's how should we be implementing this? That is where it should be. And those who do not, companies and people, naysayers who don't get on that, in my opinion, will end up like Xerox did. Like, fax machines. Of course, there are a few, but there you go. So to answer your question, which really was to talk about sustainable finance, here we are now. I will end this with just 3 definitions so people know. When we talk about sustainable finance within the debt markets, you have the bond market and you have the loan market. On the bond side, you can now essentially, as an investor, and as I said, we raise 17 billion a year. Who buys those bonds? Central banks, all our pension funds, asset managers, right? And because stakeholders, millennials, and people who are now seeing that, oh, climate risk is actually an issue, are demanding, I do not want to. And not only for social conscience, but if you were a risk manager and you're not taking that into account, like I said, the stranded assets, right? Regulation is coming that's going to say, okay, of course we know by 2030, this is it. So if you're not transitioning and you're still basing your models on things that you cannot extract, then you're in trouble. So on the bond market side, you have the green bonds, social bonds, and those are the two big umbrellas. Under green, you have blue, etc. But anything that is financing, environmentally friendly, and social, anything that is bringing about a positive outcome for populations. And so everyone should please take that on and look more into it. And if you want to reach out to me one-on-one, this is an area I'm very passionate about. I'm the apologist for it. I'd be more than happy to discuss further.
Thank you so much, Denise. Great presentation. As Andrew said, we are very proud to welcome you back home and very proud of your achievements. Thank you very much. Very important, your work in these difficult times, your work and the work of the IMF that has recovered the leading role that has had for many years in a moment in which everybody was questioning IMF and World Bank. They have, I think, risen to the occasion. So, so thank you very much. And we are going, thank you.
Goodbye, everyone.
Thank you, Denise. Thank you.